Do we have a question for the panel?
I have a question for Mark on the left. How worried are you about the perception of a loss of privacy with telematics?
Well, I'm not concerned. Well, I'm not concerned. I think it's a concept that's put about by people who don't really understand what's going on in the market. If I'm saving a customer on average, as I am, £650 on his motor insurance, the idea of me having a problem or her having a problem with data really just disappears. On average, our customers are using their cars for about 5% of the day. Okay? They get in the car in the morning, they go to work or college or wherever it is, they get in the car in the evening and they go home. It's not really that interesting. There's far more information that's available on a mobile phone. In fact, I was listening the other day to somebody who was telling me that the amount of information that's available from supermarkets, they can analyze what you're buying and determine whether or not your relationship is breaking down. So it's not a problem. I mean, if you give someone enough incentive to purchase a product, they'll purchase it, irrespective of the data.
Good answer.
Thank you.
Is anybody doing a insurance where you just pay as you go? Does that happen yet? You just pay for what you use, i.e., so I only pay for the 5 minutes.
No.
The 5%. No.
No. It's very difficult to do that. You really do at this stage. You do need a 12-month policy in order to price. And I'm not quite sure of my position here, but I think you probably would legally need a 12-month policy. But
I see.
But I have to be careful on that one. I have to get the regular. There's a man there who might know the answer. He's an actuary.
Oh, okay. Let's ask an actuary. I'm not an actuary, so you're probably much more expert on this.
Hi, Dhruv Haria. I think Aviva ran a project about 2-3 years ago where they tried pay as you go, but for some reason it didn't work out. I just didn't get market uptake.
Yeah. They did have Aviva did have a pay-as-you-go policy per se, rather than driving behaviour policy, but it was a 12-month policy.
Okay. Thanks for the clarification.
Okay. You could have an amount. You could have a figure. Right. Where essentially, obviously, depending on how much you use it, you're obviously going to get a different bill. Feasibly.
Yeah, well, okay. I mean, the way our product works, just to clarify, if I may, initially our product was a 6,000-mile product. So we had to, in order to get to market, we had to have a proposition that worked with the price comparison sites, because that was our distribution. So we had to put a product that said, comparatively, this is the price. And we would ask a consumer how many miles they thought they were going to drive every year. And if you ask most people on a price comparison site, they'll say 6,000 miles because they think it's going to be cheaper. They're probably not telling the entire truth, but nevertheless, that's what they say. So we priced our product 6,000 miles. If someone used more than 6,000 miles a year, we allowed them to top up like a mobile phone. So that was our concept.
Is it feasible? I'm sure it will be, but is it feasible at the moment where, depending on your driving style in terms of how hard you brake, how fast you accelerate, etc., you could have something very tangible where the box would actually be showing you the amount? So you could say, this trip has cost me £3.50.
Yeah, we don't drill down to that level at the moment, because you would be then suggesting that you're feeding back to the customer in real time while they're in the car, and that would cause us a problem because there's some sort of suggestion that you're not concentrating on how you're driving. Now, could you do it at the end of every trip? Possibly. We haven't got to that level of sophistication yet, but we do feed back to customers at the moment. We have a product called Drive Like a Girl, which we introduced as a result of the gender directive. Have you not heard the adverts? Okay, on radio. So the concept there is that we say to the consumer, we know that people who drive like an average female are safer, especially under 25. So if you drive like a girl, in the first 3 months of the policy, we will rebate some of the premium to you.
Yeah, the pay-as-you-go option and also that real time is stuff that's starting to bubble through from Silicon Valley. There's an app at the moment, and the name escapes me, but it's getting quite a bit of buzz over there, and it's purely in the discovery phase at the moment, and that is, it's telling you how good you drive after every trip. and so it gives both qualitative and quantitative feedback. They're pitching it as somewhat similar, kind of tapping into that vitality market, similar to kind of a feedback loop, that idea of capturing all your data and feeding it back to you. So that's definitely happening. I know those guys are thinking, the end game there is to kind of sell insurance, obviously. And then the pay-as-you-go, there are a number of people that are doing day-to-day policies and trying to do day-to-day policies. Some are succeeding, some are failing. There was one group that was doing them last year. I don't know if they're still around. It's obviously has a really big selection problem.
Actually, I have a question for you, Mark. Actually, based on what Kim said there, he said it was an app that they're developing. I assume that yours isn't smartphone related. Yours is actually a box that you put in the car. Can you see the box being replaced by smartphones?
This is my favourite subject. Absolutely not in the foreseeable future. I'm sorry to disagree, my co-panelist, but we've got to understand that technology is wonderful, but you've got to apply it to a business requirement. And in motor insurance in the UK, 85% of the premiums are spent on claims. Now, in order to use this technology properly, we need to mitigate claims costs. And the only way you can really do this is if you have something that provides you with reasonably accurate data. And it ain't going to happen with an app. It's got to be something that's bolted onto that car and gives you really reliable data about crashes and the way that that vehicle is behaving. And unfortunately, let me tell you, we recently downloaded an app from one of the leading UK motor insurers in the UK, and we have never used that app in a motor vehicle. We've used it on a train and a plane, and we've walked down the street with it, and we've actually managed to secure maximum points on that application, and it's never been used in a car. I think downstream, if you can harness the technology and you can get the reliable information and to use against mitigating claims, I'd be absolutely delighted, because it'd be a lot cheaper. But at the moment, it ain't going to happen.
Follow-up question. If not apps, do the vehicle manufacturers own this market? There seems to be a railway sort of problem here, knowing that Mercedes and BMW now have VC funds, and Ford is working really hard on this. It seems like everyone wants to own that data.
My second favourite subject is connected car. I absolutely agree that in order to expand the market of telematics motor insurance, you need to reduce the cost of technology. Now, if the motor manufacturers are prepared to put the technology in the motor vehicles at point of manufacture, we can harness that technology, clearly that's going to work. And we're talking to a number of motor manufacturers at the moment who have been, actually surprising to me really, working with this since 1996. And one of them we're talking to has 6 million customers in the States already using this technology, and with insurers, and this horrible expression they use, infotainment. So without a doubt, my view is connected car is the way forward, whereby a whole bunch of different businesses are harnessing the technology that's put in by the motor manufacturers at point of manufacture. Sorry.
Are you going to expand this into sort of adjacent markets? So could you apply it to a house, for instance?
I'll avoid saying this is my third favourite subject. Yes, clearly there are products available at the moment which are quite interesting, whereby you can have a product at a reasonably priced product that you could put into your home yourself, self-installed, which would deal with things such as intrusion, fire, flood, etc. There are discussions at the moment about how you could market this product and work with a household insurer. But the whole idea of the Internet of Things and connectivity, I can't remember the actual year. There was a report recently said, I think it's by the year 2020 or something like that, there will be 7 connected devices for every human being on the planet. So that's your fridge, your house, your car, and everything. It's all just going to be wired up, and the information is going to be flying around all over the place. And my view is, for what that's worth, is that we really do need to be looking at all of this as an industry to see how we can tap into it for the benefit of the consumer. We were talking earlier on, so I'm going to get my soapbox now, but we were talking earlier on about what the consumer thinks of the insurance industry. I'm talking about the consumer now, and I actually passionately believe that what we've done at InsureTheBox is turn around and say, do as you would be done by it. What does a consumer actually want? Start with a blank sheet of paper and let's provide the customer with something they want. Let's use the technology. Let's get some clarity in place here and be transparent. And if you tell the truth often enough, eventually you get found out.
Okay. Should we take another question?
Richard at Pru. Future technological developments, basically what Mark's been saying as far as how this goes for telematics for car insurance. As you say, you want it to be telematics for health and life insurance. How do you see that technologically developing over the next 5 to 10 years in a way which, the manufacturers put it into the cars themselves and so on and so forth? How do you see it going?
That's a good one. I guess it's around having a conversation actually just before this around the technology we're using and becoming more accurate. So some of the challenges they're facing in car insurance is getting the technology right within a phone is a challenge and will be solved. And I guess there are challenges with what we use around Fitbugs and Polar. They're not perfect ways of tracking health, so that will improve. I think there's other bits of technology around our health, whether it be other patterns of living which we can use and inform our pricing, because it will tell us a bit around the likelihood of getting other kind of illnesses. So I think technology will become a bigger part of it and will be more useful going forward, but I don't know exactly what that's going to look like. Yeah.
Okay,
Hi, Julian Smith. I'd just like to ask the panel, we've heard about the difficulties of disrupting an industry which has got lots of regulatory layers over it, but I think we also heard that there's a good chunk of the value chain which is in and around the distribution side where there's value to be gone for. I'm not sure how many more opera singers or Meerkat price comparison sites we need, but where do the panelists see the opportunities for entrepreneurs in this particular part of the value chain?
I guess this is a good one to pick up. Look, I would disagree with some of my co-panelists that A, the disruption is in the distribution, and B, that it's kind of difficult to penetrate. I think both are a perception issue, and there's a couple of perceptions there. You have to be quite naive to want to disrupt this industry because it's going to be hard, and the probability is going to be really low. And there's not that many people floating around that A, are interested in insurance, and B, are that naive, but C, have the abilities to actually execute. That being said, it's a perception problem. It's not as hard as we're making out up here. Regulation is there for the consumer. If you think about it, you can get through. It's not that hard. You can disrupt the manufacture of insurance. You can disrupt the way it's being done. And one of the things that really kind of gets my goat a little bit is we use this word disrupt. And I'm just trying to think what we're disrupting here. It's a little bit of a love fest for all the incumbents at the moment that are just rolling out, features. And that's super. They should be doing that. That's absolutely their job. That's not disrupting. That is adding features. But it's an evolution. There are people coming, the banks are being disaggregated at the moment, foreign exchange payments are going, peer-to-peer lending's going, it's all happening, but it's finance, it's slow. You've got to hit the really early adopters who are really fervent about this, and there's a really, really big group, somewhat curated, as was mentioned before, by peer-to-peer. But, crossing the chasm is hard and slow. But I think one thing that's really in our favour, and you sort of see this across Silicon Valley and also the startup world, is that the early adopters have united across the world. There's no logic anymore in starting a business in the UK and thinking about the UK for the next 10 years and penetrating into that market. It's just an absolute dream. But if you think about going and grabbing all the early adopters, Germany, France, Spain, they read the same blogs, they follow the same startups, they have the same ideas, and they talk about it every day. That community now cuts across those borders, and that really gives us an access to a huge pool of customers that get it. How long is it going to be before it penetrates the mass audience? And I think that's the key difference and the key question here is, a lot of the stuff that I talk about, we're talking in the future, and got to start it today with a group of believers, but it will come up and bubble up through the consciousness in the future. Whereas telematics today, that's a tool for today. People get it and they get discounts today. It's an innovation on the insurance product today. But, things take time. So I think it'll happen, and I think it'll grow from where it is. But, we do have to penetrate those perception problems.
I sort of agree with Kim. I think you've got to have very deep pockets to do what he's doing. So you've obviously got some great backers. But I think on the distribution side, I think there's a genuine opportunity right now. I think, if you've got a platform, or you can persuade someone who's already got a platform that, say, links all the insurers together, then surely perhaps there's a way for you to come up with a new model that actually challenges the aggregators in the market. So I think you've just got to look around at different sort of opportunities. You've got to speak to some of the incumbents, speak to the technology providers. We're one of them. You've got to speak to some of the insurers and say, look, okay, you've got a platform that you've set up. You've got your own claims department. You've got a process of doing business. Would you ever consider opening that to some entrepreneurs in a slightly different way? So I think you just need to challenge it. I agree that there are incumbents there. I agree that they're quite myopic, but they're that way deliberately because it's very profitable for them. But if you come up with ideas that mean that they can make more money out of the industry, and you're actually helping them by helping yourselves, I think that's the way that you can really start to change the market in the short term, and that might give you the money to change the market in the long term.
I'd agree in sentiment with both of those points. I think the thing that makes finance slightly different from other industries is the layers of regulation, and regulation is both as hard as people make out and also sometimes a lot easier than people make out, and it's this uncertainty about where you're going to push and whether it's going to work which makes it a difficult thing to work with. I think the challenge for the manufacturer of insurance is that effectively, give or take a bit, it's kind of covered by a European directive that's taken 13 years to negotiate now and is rolling out like a battleship across Europe. The Americans are sort of doing something similar. The framework for the regulation has been adopted basically from, they're using the same framework in Turkey, Mexico, Peru. Australia's got something slightly heavier in place. So there is a global agreement between regulators to sort of tighten this up. And what we've seen in the last couple of years is a kickback from the financial crisis. There's been a huge amount of detail put in. In the past, you've had the opportunity to think through some of the rules, but now what we're seeing is a lot of detail. So it's not impossible. Anything can be done. These rules were put in place and they can be adapted and changed in the future. But particularly around anything to do with capital and the solvency of financial companies, we've seen a very, very heavy response to the financial crisis, possibly more so than was warranted. And it might just be that it will take a few years to unwind. So again, it's a question of deep pockets and patience if you really want to dominate that market.
Sorry, could I just come back in on that particular point, which I think is an interesting one, drawing a parallel against the banking industry, where you've had the same, I guess, regulatory response post the financial crash, and there's been a real direction of travel towards tightening information requirements and as well as the capital ratios that we've seen. But that's provided opportunities because the banks didn't have the ways of pulling together the various bits of data and analysing them real time that some of the entrepreneurs have been able to come into that space and deliver. I guess the difference with the insurance industry maybe is because it's all about the long-term data that the actuaries have their hands around already, and there's no disruption to do. I don't know, but I think regulations have been a friend to disruption of the banking industry, whereas they don't seem to have been the same in the insurance space.
I think it's on this point, it's probably a point of perception. So insurance, you can insure somebody without a computer if necessary. You can underwrite off the page, but most insurance companies now in the last couple of years have had to go very heavily up the curve in terms of technology, so capital models, calculations. It's not universally spread, so what they haven't done is updated all of their IT and infrastructure. So there's lots of areas where insurance companies don't have cutting-edge technology, but in certain areas this regulation has driven innovation. You've seen one or two software companies which have got innovative products benefit enormously. So something called Remetrica in the London market has done incredibly well, which is sort of a capital modelling platform. But that push from the regulation has changed people's mindset, so it kind of created an environment where there are new bits of kit, and when one department gets a new piece of technology and does something interesting for them, you do get a discussion in other departments that maybe some of their software, which is 15 years old, is looking a little bit out of date. So regulation does raise the bar in what's acceptable. The challenges, though, is that in terms of innovation in finance, it's possible to do lightweight software in some areas, but quite often people just need it to work. The minimum viable product, if you follow lean, the MVP in finance is just very heavy. It's got to stand up to scrutiny, and I think it's that which makes it a deep pockets industry. It's still entrepreneurial, but you have to have entrepreneurs with deep pockets.
Okay, I'm going to have to close the panel there, given the time we've got. Thank you very much, guys.